Trump's tariffs are 4D chess, the supporters of the US president's policies have been saying. But even these supporters have had a hard time explaining policies like putting tariffs on islands inhabited only by penguins. But what if I told you that there is a method to Trump's madness, and that everything could be going
according to the plan?
Believe it or not, but there actually is a plan, and it was first proposed in November last year. Today, we're going to reveal the details of Trump's economic plans, including who put them together, what comes next, and how it could all affect the markets. My name is Nick, and this is a video you do not want to miss. In November 2024, economist and former investment strategist Stephen Moran published a paper titled, quote, "A User's Guide to Restructuring the Global Trading System." The paper explains how different tactics, including tariffs, can be used to rebalance global trade and bring manufacturing back to the US. Moran was subsequently nominated by Trump to be the chairman of the Council for Economic Advisors, a US agency that advises the president on economic policy. Moran was approved by the Senate in mid-March, and in the weeks that followed, Trump doubled down on his tariff policies. Not surprisingly, many market analysts and media outlets have declared that Trump's policies have their roots in Moran's paper from November 2024, and some have even gone as far as to argue that the paper is a step-by-step guide for Trump's policies, which is understandable as the title starts with a user's guide. However, in a recent interview, Moran stressed that the paper from November 2024 was not a guide, but just a, quote, recipe book of policies that Trump could use as part of his goal to rebalance global trade and bring manufacturing back to the US. Notably, he said which policies are actually used is up to Trump. And that's why it's surprising that some market analysts and media outlets have not only continued to argue that Moran's paper is a step-by-step guide for Trump's policies, but that the goal is to weaken the US dollar as part of a so-called Mar-a-Lago Accord, even though Moran says the opposite in the paper. For context, Mar-a-Lago is a club in Florida that's owned and operated by Trump that became famous during his previous presidency because he would meet other world leaders there. What's fascinating, though, is that the original owner of Mar-a-Lago donated the property to the US government in the 1970s, hoping that it would be used as a, quote, winter White House, which is basically what it has become. As for the Accord part, that's a reference to the Plaza Accord, which was an agreement between the United States and other countries to weaken the US dollar to rebalance global trade in the 1980s. This agreement took place in the Plaza Hotel in New York City, which Trump acquired a few years later. It's assumed that Trump will enact a similar accord at Mar-a-Lago in the coming months for the same reason. There are just two problems with this assumption. The first is that the Plaza Accord took place between the US and countries it was allied with, including Japan. Now, for reference, Japan was essentially the equivalent of what China is now, a rapidly growing economy that was seen as competition to the US. In case you haven't noticed, the US and China aren't very friendly these days, so the chances of President Xi flying to Florida to meet with Trump anytime soon are objectively low. And this is a problem because the trade imbalance that the US has is primarily with China, so China would also need to be part of any sort of Mar-a-Lago Accord. The second problem ties into something that Moran mentioned in his paper, and that's that the US dollar would need to strengthen first so that the US has lots of negotiating power for these Mar-a-Lago talks. Notably, Moran sees tariffs as a means of strengthening the US dollar for this purpose. In case you haven't noticed, the US dollar has been falling fast, and this gives the US less negotiating power and effectively makes a Mar-a-Lago Accord unnecessary because the US dollar has already weakened significantly. And this begs the question of what's going on with Trump's policies and what comes next. Before we dig into the answers, smash that like button if you're enjoying this video so far and subscribe to the channel, and don't forget to ping the bell as well to make absolutely sure you don't miss our next one. Now, to understand what's really going on with Trump's policies and what comes next, we first need to understand why Trump is doing what he's doing. Let's start with the awkward stuff, and that's the seemingly irrational decisions being made, like putting tariffs on penguins. As you've probably heard, Trump has been getting input from a lot of different people behind the scenes, some of whom are more competent than others, to put it mildly. It seems that the rational decisions are coming from the adults in the room, whereas the irrational decisions are coming from the non-adults. Obviously, Stephen Moran was asked about the now infamous formula used to calculate the Liberation Day tariffs in his recent interview. He revealed that the formula was proposed by someone without naming names, and Trump went with it. The way Moran answered it made it sound like he was against the idea. And this is expected, given that he had previously warned that if Trump started off with high tariffs, it could create uncertainty in the markets and could cause economic weakness. Moran said this in an interview shortly after the 2024 paper was released and advised gradual increases in tariffs instead. And this is where things get interesting. Many have speculated that Trump started off with high tariffs to intentionally crash the markets and incentivize investors to allocate to US bonds, thereby lowering their yields. Now, for those unfamiliar, the Trump administration is explicitly trying to lower bond yields because the US government needs to refinance $9 trillion of debt and thus needs to lower yields if it can. Of course, this speculation completely disappeared after US bonds started selling off, causing yields to rise instead of fall. It's still not entirely clear whether the sell-off was due to foreigners selling US bonds in protest of Trump or hedge funds being forced to sell bonds because of a basis trade. It was probably a bit of both. In any case, the fact that US bonds eventually fell along with the stock market made Trump's tariff decisions look more like a bad coin toss than a 4D chess. However, it's still possible that the goal of the tariff shock was to do the other thing that Moran warned would happen as a result: weaken the economy. And this sounds crazy until you consider the effects that tariffs have on inflation, which has been another major concern. According to Moran, the inflationary effects around tariffs are unjustified because history shows that most of the inflationary effects are offset by a depreciation in the other countries' currencies.
The Coin Bureau Deals page. It won't make you stronger, but it will make you better at crypto.
In that 2024 interview, Moran explained that during the previous Trump administration, the overall tariff rate on China was around 17%. In theory, this would have resulted in prices rising by 17% in the US. In practice, however, the Chinese yuan devalued by 15.5%, offsetting almost all of the inflationary effects. The remaining 1.5% was apparently swallowed by the US companies importing these Chinese goods. The catch is that this time the Trump administration wants the overall tariff rates on China to be much higher. Probably not the 145% that was recently announced, but also probably not the 17% from before. It's safe to say that China will not devalue its currency to offset the finalized tariff amount, which will likely be very high. For instance, suppose that the final tariff rates on China are 40%. China might be willing to devalue the yuan by 10%, maybe even 20%, but there's no chance that it will devalue its currency by 40%. And that's just because Chinese citizens losing 40% of their purchasing power would likely result in a lot of domestic strife. Come to think of it, this could be the reason why tariff negotiations with China are going so poorly. Regardless, this means that the remaining 20 to 30% would be passed on to US consumers. It goes without saying that this would not be ideal because it would likely create lots of social unrest in the US. It would also force the Fed to keep interest rates high, and more importantly, this inflation would cause a sell-off in US bonds. But what if it's not possible for US companies to pass these costs on to US consumers because of, say, economic weakness? In this scenario, companies would be forced to swallow most of the costs of the tariffs. In practical terms, this would mean higher expenses and lower profits for corporations. At first glance, you'd think, well, this would be bad for the stock market. Lower profits means lower stock prices. Upon closer inspection, however, you realize that the major stock market indices such as the S&P 500 consist largely of tech stocks that are mostly immune to Trump's tariffs because they don't deal very much with physical goods being imported from China. The few that do, such as Apple, have record levels of cash on their balance sheets, meaning they could easily offset the costs by adjusting supply chains or otherwise. Never mind the tariff exemptions that were recently announced for phones, laptops, and microchips. In sum, then, Trump's wild tariffs are likely to result in economic weakness, which will make it very difficult for corporations to pass on the costs of these tariffs to consumers. This means that corporations will have to swallow these costs, which would have the practical effect of protecting both the US consumer and the US government from inflation, with minimal impact on the stock market due to how indices are structured. Make no mistake, there's no way of knowing that this was the intention behind Trump's policies, but for the time being, it looks like this will be the outcome. Whatever the case, this only answers the question of why Trump started off with high levels of tariffs. It doesn't answer the question of why he wants tariffs to begin with. And this is where Stephen Moran's 2024 paper comes in. It reminds us that tariffs are just one of the many tools that could be used to achieve Trump's goals, which you'll recall are rebalancing global trade and bringing back manufacturing to the US. As such, the real question is why these things need to change. Moran provides a perfect answer in his paper, quote, "As global GDP grows, it becomes increasingly burdensome for the United States to finance the provision of reserve assets and the defense umbrella, as the manufacturing and tradable sectors bear the brunt of the costs." In other words, being the issuer of the world's reserve currencies creates issues and imbalances in the US economy. I'll explain exactly how with an example. Suppose you're China and you want to buy oil from Saudi Arabia. You'll need US dollars to buy this oil because it's priced in US dollars, at least for now. There are only two ways you can get US dollars to buy the oil you need, and that's to sell something internationally for US dollars or to borrow US dollars from someone else. Suppose you decide to sell something internationally, like a bunch of EVs. Thanks to the US military protecting trade routes, you're able to seamlessly sell these EVs around the world. Now you have a bunch of US dollars to buy oil. But let's suppose that you end up with way more dollars than you actually need. What do you do with them? You can't put them in a bank account, especially since FDI insurance only covers up to the first $250,000 of deposits. You've got billions of extra dollars, and the only place you can keep them is in US bonds. And that's because US bonds can be easily converted to US dollars and they also earn a yield, just like a savings account. Now, bond yields are determined by price, with a higher price meaning a lower yield and vice versa. In turn, the price of bonds is determined by supply and demand. Suppose you're buying billions of dollars of US bonds. This causes the price of US bonds to rise and their yields to fall. The consequence of this is that interest rates in the US fall because bond yields are used as a reference rate, as the baseline for interest rates on other kinds of debt in the economy. A fall in US interest rates results in more borrowing by US consumers, US corporations, and the US government. This results in US consumers purchasing more stuff from China, giving China more US dollars, which it then invests in US bonds. It also results in US corporations moving their operations overseas because they can see that they can make a bigger profit margin selling EVs made in China than EVs made in America. As for the government, it spends more than it can possibly afford, flooding the domestic and global economy with trillions of extra dollars. Like China, all the recipients of these dollars need a place to keep their cash. Some will buy bonds, but most will invest into US assets because they yield higher returns. And this pushes the valuation of US assets higher and higher, eventually financializing the entire US economy. The result is that only wealthy investors, corporations, and those closest to the US government benefit, and everyone else suffers because the real economy is slowly but surely being hollowed out. Eventually, this becomes a problem because the US needs to be making some of its own things as a matter of national security, such as weapons and medicine, but almost all of these things are made elsewhere. The good news is that the US, being the issuer of the world's reserve currency, the provider of the world's reserve assets, namely US bonds, and the policeman of the planet, are all things that can be monetized. The crux of Moran's paper is simple, and that's to make countries pay for all these perks in a way that changes the trade and capital flows we just described, and finances the revival of the US economy. With this perspective in mind, Trump's tariffs start to make a lot more sense. And if you read the end of Moran's 2024 paper, he literally tells the reader, quote, "A second Trump term is likely to be even more forceful than the first when it comes to reconfiguring international trading and financial systems. And that, quote, volatility risks are material, which is precisely what we've seen." Moran also specifically states that, quote, "Tariffs are a tool for negotiating leverage as much as they are for revenue and fairness. Tariffs will likely precede any shift to soft dollar policy that requires cooperation from trade partners for implementation, since the terms of any agreement will be more beneficial if the United States has more negotiating leverage," which you'll remember is what we discussed earlier. The caveat is another thing we discussed earlier, and that's that the tariff strategy doesn't seem to be working as it was intended. The US dollar has been weakening, not strengthening. The bad news is that this will make it harder for the US to get what it wants from the tariff negotiations. The good news is that a weaker dollar was still technically the end game, because a weaker US dollar is good for Trump's goals. Fortunately or unfortunately, tariffs aren't the only tools available. The US could back out of military organizations like NATO unless other countries pay more, which is arguably what we're seeing right now. The US could also refuse to secure key shipping routes unless it's paid to do so, which is also what we're starting to see happen, specifically in the Red Sea, where the Houthi rebels in Yemen are disrupting trade to Europe. As you might have heard, paying for such military security could involve forcing counterparty countries to swap their short-term US bonds for long-term US bonds to bring down long-term interest rates. The Fed would then create a special facility to minimize bond market volatility by making it possible for these countries to borrow US dollars against these long-term bonds instead of having to sell them. That, though, would require the Federal Reserve Board being on board with Trump's tariff plans and could be part of why Trump may want to get rid of Fed Chairman Jerome Powell. More about that in this video over here. Alternatively, the US government could start taxing inflows of foreign capital into US assets, but such measures would be even more extreme than forcing other countries to buy long-term US bonds. As we've also noted in other videos, the fact that the US economy is so financialized means that its markets need to stay relatively robust during this transition period. Otherwise, the US could lose its remaining leverage. This is presumably why Trump has walked back many of his initial tariff threats over the last few weeks, despite not receiving many concessions from other countries. Per Moran's 2024 paper, quote, "President Trump has shown repeated concern for the health of the financial markets throughout his administration. That concern is fundamental to his view of economic policy and success of his presidency." And this brings me back to the big question, and that's what comes next in Trump's economic playbook. The short answer is that it depends on what Trump's advisors propose and who he decides to listen to. Nobody knows that except Trump and members of his inner circle, most of whom also seem to be in the dark. As brilliant as his plan is, Moran is just one of the many people in this circle. Although Moran has been tight-lipped about the details of what's been going on within this circle, there is one thing he highlighted in a recent interview that everyone seems to have missed, and that's deregulation. To recap, it's possible that the reason why Trump's Liberation Day tariffs were so over the top was to create enough economic weakness so that it's not possible for most corporations to pass on the costs of tariffs to consumers. Even if this was some 4D chess plan, though, it probably won't be enough by itself. And that's why Moran has been underscoring deregulation as one factor that could cause inflation to drop, even if tariffs are implemented. He even argued that deregulation is the main deflationary force economists are missing, and that's because the effects of deregulation are impossible to model. By this logic, it would be hard for Moran to argue in good faith that deregulation will be as deflationary as he seems to believe, but there definitely seems to be something to it. And that's because Treasury Secretary Scott Bessent has also been pounding the table about deregulation in recent interviews. While markets were falling and bond yields were rising, Bessent was shrugging it off, saying he's not really involved in the tariffs and that he's been focused on deregulation. And this suggests that if there's a consensus about any economic policies in Trump's inner circle, that's that deregulation needs to happen ASAP. Come to think of it, this could be because deregulation is what the Trump administration is promising corporations in exchange for swallowing any costs related to the tariffs that could be offset by currency depreciation. It could be something along the lines of tariffs will increase your expenses by 20%, but we will cut enough regulations to lower your other expenses so that the total cost to you is minimal or zero. Again, it's not entirely clear if this will be enough because it's impossible to model per Moran's own admission. Even so, we reckon it's clear that Trump's inner circle sees deregulation as the solution to the inflationary side effects of the tariffs, and it is therefore the next economic policy to watch very closely. But a word of warning. If these deregulation plans fail, then the US economy could end up with stagflation, that is, weak economic growth and inflation because of these tariffs. The stakes are high, and you can find out what that would mean for the US economy by watching our video on it right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you guys very much for watching, and I'll see you again soon.